What the heck is an annuity? Sounds financial, sounds complicated, and I'm guessing that if you're at a party or something and somebody brought it up, that you might pretend that you know what it is just so you don't feel uneducated or whatever. And we care about that at I&E. So today's video is going to be all about what is an annuity. We're going to talk about the basics. We're going to talk about some history of annuities and some differences in what's available. If you'd like us, if you want to click the thumbs up, if you want to click for notifications on future topics, we'd love that. And of course, subscribe to join the I&E movement. We'll be rolling out a lot of topics that are concerned with all things estate planning, tax planning, wealth protection, wealth building, life insurance, and anything in between. So we'd love to hear from you on topics as well. And with that, let's get started. An annuity is basically a contract. And we like contracts here at Insurance and Estates because they provide some predictability when it comes to your wealth building and your planning, your strategic planning. And they also provide asset protection. So an annuity is a contract, and what it does is it takes an income stream that you put a sum of money into an account, and it offers an income payment for a set period of time for life, the life of the account, depending on the annuity. And believe it or not, this idea of taking one lump sum or a certain amount, converting it into an income stream for life, originated with the Holy Roman Empire under what was called the Tontine System. It was a government way of raising money for battle, believe it or not. So a soldier would put a certain amount into the fund. They would get a guaranteed income for life. And on the positive side, they may end up with income for many years if they survive a long time. Of course, they may be killed in battle, and so they wouldn't benefit. The modern annuity in this country began about 1912, really picked up steam after the Great Depression. You can imagine why. I'll let you speculate. The annuities since then have generated a lot of interest and some controversy as well, and I'll touch on that controversy. What are the types of annuities that are available? Two primary types. You have an immediate or deferred annuity. An immediate annuity is where you would put the lump sum into the account and you immediately or fairly quickly start getting payments. You can also have a deferred annuity, which would be deferring the payment starting, and that would allow the account to grow over a period of years, a period of time. If that's the case, if you're selecting a deferred annuity, you're going to want to know how that account is going to grow. And so there's different options for that, very similar to when we're talking about permanent life insurance options. So you have basically three choices, anything from a fixed interest, kind of a formula that's applied for the growth of the account, to a variable, which is like a mutual fund within an annuity account. And in the middle, we have indexed annuity products, which is really basing the growth of the fund on a market index like the S&P 500. So that's kind of the range of risk. So it just depends on risk tolerance and goals and age and all these things that can play into that mix. And all these things have to do with what we call suitability in the world of annuities. And suitability is, I'm bringing it up because it's probably a big reason why annuities maybe have had some bad press at times in history. They have to do with matching the right person with the right annuity. So for example, you wouldn't tend to match an elderly person with a deferred annuity where that account would be slated for growth and the income would be deferred. It might be more appropriate to put that person in an immediate annuity for basically retirement planning and hedging against market risks, wanting to preserve a certain amount of income and these kind of things. Vice versa, for a younger person, they may benefit much more from a deferred annuity where that account would have time to grow and it would supplement that person's income for retirement down the road. One more thing about annuities, they can be qualified or unqualified. If you have qualified accounts like IRAs and 401ks, they can actually be rolled into a qualified annuity as part of a strategy to, again, limit market exposure, these kind of things, and you wouldn't lose the tax treatment of those accounts by rolling them over. So just something to know about qualified and unqualified annuities. Suitability, immediate, deferred. Now you've got some jargon to work with and some understanding when it comes time to connect with that expert to design your customized plan. With that, we will see you in the next video.